Good evening everyone, Senthil here. Is my audio and video clear? Can everyone see my screen and hear my voice clearly? Can someone confirm is my audio and video clear? Thank you everyone. So as the session comes to an end, I can see attendance is very low. So I request any students who is part of the group, please communicate all other students to go and watch the recording. So without fail, because if you fail to complete this in this series, this session in this series, it will drag, it will drag, it will drag. You may miss the entire session. So it's my humble request. Please communicate to other students also, and whoever has not taken the previous session, please complete it as soon as possible, right? So let's start. So Fibonacci is over, and we have 3 more sessions left: derivative strategy and derivative strategy 2 and 3, and money management. So let's start. Hedging. Disclaimer. Straddles and strangles, and this can be done only in options. Long straddles, short strangles. So these are the two types of straddles. So it's a simple combination. As I told you, while doing an hedging or combination, you can do even 1,000 combinations. There is nothing wrong, but we cannot learn everything. We cannot implement everything. So it's a tedious process. So we'll be learning limited things. It can be done in index and stock options. So long straddles, a very simple thing. Buy one lot call option, buy one lot put option at the same time. So let's, I missed opening Zerodha, just give me a minute. Okay, it's there. So buy one lot call option and buy one lot put option at the same time. So let's open Sensible. Let's take Reliance. Let's take the chart. Let's knock off this. Okay, you can see there is a consolidation phase. So we should avoid picking long and short straddles in this particular box trading zone, because it may continue in the next 3-4 days. If it is continuing in the same box, what happens is the premium which you buy long side and put side both will erode. So it should be in a trending market. Either on the top, either on the bottom. So if it is coming down, that is fine. If it is going up, that is fine. If it is going up, that is fine. If it is further breaking down, that is fine. So it should be a high volatile trending. Buy one lot call option and buy one lot put option at the same time, preferably ATM or first strikes only. You should buy ATM or first strikes only. If you buy both the premium in OTM, so it may not be useful. So buy preferably ATM or first strikes only. Both the premium should be more, that is less or more than or equal to same price. It should be more or less equal to same price. If it is 9.5 and 8.75 accepted, 9.5 and 10.25 accepted, 7 accepted, 10 accepted. Usually it will not be in round figures, but round about the figures is accepted. One cannot be 4 and one cannot be 10. One cannot be 12 and one cannot be 20. Right? Stock should give either 3 to 5% movement in either side. Stock should give either 3 to 5% movement in either side. So now we may take VEDL. So I'll tell you stock selection process for that also. You can see just now I told you, right? Stock trending on completely on top. Let's say even if you might have taken this premium by today morning, so let's do a small calculation. You can see here 347, opening is somewhere about 347. So we might have taken VEDL, call and P. So it is just an example. Please take with a lot size less than 1500 in the beginning days. Then you can expertise yourself. Then you can make lot size, higher lot size things. Okay, 347 is not there. Let's take 350 call. 350 call. 350 put. Okay. So now today morning it was, let's take daily chart. $12 and today morning it was 11. Can we take this? Can we consider this 11.2 12? Can I get one line of S from everyone? Is this right selection or wrong selection? If you want to be very precise, so let's change this into 5 minutes time frame and let's see. Well, let's say like 9:25 we are taking the position. 14 rupees. Okay, 14 rupees and 11 rupees. No, we cannot take this. 14 and 11, no. So maybe we have to take 347, 345 put. Still it is not matching the condition. 14. So you can see here 14 and another one 14. Right. So now this is called as outflow of money. So totally it is 28 rupees. We'll buy call option and put option together so that it is called as outflow of money. So in the same day what happened, it closed, one is closed at 18 rupees and went high. Let's take the high and low. It went till 26 rupees, 26 and low, that is the time is somewhere around 1 o'clock, 12:45 and low was 7 rupees. 7, so let's see the calculation, 33. We bought at 28 rupees, we sold at 33 rupees. Even if you take as a EOD basis, end of the day basis, 18.7, 8.7, 18.7, 8.7. Now it is 27, it is around the cost only. So see, premium, when you take the premium, it should move completely out of 3-4 strikes. It should completely move out from 3-4 strikes. So we have taken at 347 when the market was at, let's see the price again in the cash market, 352. So it should reach it should reach at least 365 and close. So now it is 361. When it was at 368, it was highly profitable. 33, that is 5 rupees extra. 5 rupees extra. The lot size is 20,000. I'm sorry. The lot size is 2,300. So 5 into 2,300 approximately, you can see this is the profit for an investment of 64,000, which is too much. So I'll take you through one more example. Let's read that and we'll come back again. Okay, buy one lot call option and buy one lot put option at the same time, preferably ATM first strikes only. Both the premium, it should be more or less 9 point around the price, both the premium should be in the same price. That is the meaning. Stock should give 3 to 5% movement minimum either side. Sideways market or flat movement will give big loss. Premium will become zero. Stop loss is very important. Default stop loss should be 25%. That means when you buy a premium of 17 rupee 50 paisa, you should keep a stop loss of 25% on this premium value. Are we clear? 25% on this premium value, so that we will protect the balance capital. Maximum holding period is 2 to 3 days, so that any day which is profitable, highly profitable, we can hold the position, or else we have to close it. No weekend holding. Avoid trading in long straddle in the first week of contract, as the premium will be completely blown up, so it will depreciate fast. Maximum premium both the side should not exceed 20 to 30,000 rupees. So now when we come here, it is 64,000 rupees, which is completely wrong premium selection. That is what I told you, to pick the lot size less than 1,500. So usually this small values premium will have a costly premium. Small value stocks will have a costly premium. But if you pick like Reliance, Voltas, HCL, maybe like TCS, it will have a very affordable premium price, so that the volume is also very high. The liquidity or the volume is also very high. Right? Best time to trade this strategy is second, third, and fourth week, especially fourth week. But you should be very clear on fourth week. If there is no breakout, both the premiums will become zero. Okay. Technical entry with stop loss is important, because simply we cannot buy any stocks. Simply we cannot buy any stocks. You should have a proper technical entry, and you should have a proper stop loss. Example, you can see SBI August 440 call, 440 put, 1500 lot size, 12.75. Margin required is approximately 37,000. It should be less than 30,000. So that is the minimum benchmark. Okay. So you can see here the optimization. Let's do it live. Let's do it live. Let's take SBI again. Okay, you can see here it is in the top. A good swing is also there. So let's pick a combination. Current market price is 779. Good. So we can take 780 call and 780 put. So both we are buying one lot. So maximum loss is 41,000. Still the premium is high. So what we'll do is we'll buy. Right. So it came now less than 30,000. It came now less than 30,000. Now already it is showing 1 day minus. Let's take 1 day negative. That is T plus. Okay, it is T plus 3, because today is the trading day. Tomorrow market holiday. It is considering the next day. So now if it moves 3%, we may get a profit somewhere approximately in between 4 to 6,000 rupees upside. If it moves 3 to 3% upside, the profit will be somewhere on a capital of 30,000 rupees. It will be somewhere around 4 to 5,000 rupees. And if it is moving 5% upside, the profit will be exponential. The profit will be exponential. The put option will lose the profit, will lose the premium, but the call option, you can see here, the premium what we bought at 9 rupees will become 1. Maximum it can become 0 only. Any doubt in this, sir, madam? When the premium is completely against us, when the market is completely against us, what will happen? The bought premium completely it may become 0. Right? It may become 0. There is no unlimited loss. But when you see here, we bought at 779. When the price comes to 818, it becomes deep ITM. It will give you 2 to 3 times profit on the loss amount. See, loss here is 12,000 rupees and profit here is 21,000 rupees into 2 times. Right? This is on an upside. Now, even if you see the downside, 1,000 rupees only. Okay, 3%. 3% movement is very, very important. Nothing less than 2%. Nothing less than 2%. 2% we will break even the cost only. Can I get one line of yes from everyone? If the movement is only 2%, we will just do break even cost. You cannot see profit at all. Let me show you here. Right? We make 2%, we will make break even cost, and 3 days goes. And 3 days goes, and if it is only 1%, we will make loss only. There is no doubt in that. Next. If it is 5%, again we get exponential profits. Right? So it's a very, very sensitive strategy. If you buy and if you ignore, the whole amount what you bought will bound to become zero. Please remember this. The disadvantage in option is the moment after you buy, our mind will not allow us to put stop loss and close the position. Yes, you can use in result season. Yes. Time to trade and failure model. Double top, double bottom, any reversal pattern, any trade setup, results, elections, you can use anywhere. Wrong propositions, that is strike prices, one buying at 4 rupees. So I am very sure about long position. I am taking 10 rupees premium for call, and I am very sure the stock will not go down. So I am buying only 5 rupees premium for put. That is wrong proposition. That is a different strategy. It will not come under this setup. Wrong proposition, wrong strike price, wrong durations. I am sure that it will give 10% movement. It will give 5% movement. After 15 days, what will happen? No use. Let me show you again. Even if you are getting 5% movement, after 15 days, there is no use. Just a minute, 15 days to expiry. See what happened? If it is 5% movement, if it is only 3% movement, I'm sorry. If it is only 3% movement, all the premiums will be eroded. All the premiums will be eroded. You can see here, even if it is giving 3% movement, but at the time of expiry, no use at all. Are we clear, sir, madam? You cannot buy and hold this more than 3 working days. Are we clear? Can we change the strike price so that to maintain the same premium price? Yes, you can do. Yes, you can do. See, here it is 9.6, 9.4. In case if it is like 975, it is coming 9.6, you can do that. You can do that. Premium is the only constraint, not the strike price. Premium is the constraint. Sometimes premium will be cheaper. That means that side is weak. Sometimes the premium will be cheaper. That means that side is weak. That means I'll explain you. Current market price is 780. Okay, when we buy 790 call, premium will be 14 rupees. 770 put, it should be somewhere 12 to 14, right? Yes or no, sir, madam? Am I right or not? It should be somewhere 12 to 14 or 12 to 15. But here it will be only 8 rupees. That means that side is weak. That side is weak. Buyers or the traders are very sure about uptrend. That is the reason the premium itself is in premium, high premium. Are we clear? Can we use the strategy in index? Yes, you can use an index, but you should use whenever there is a huge movement. And you should use this whenever there is a huge movement, or else what will happen is in today's market like today, the premium will be completely eaten, right? The premium will be completely eaten, so we will left out with nothing. Both call and put, both will be eroding. See, today was the expiry, right? Market started at 22,708, 22,708, went high till 22,774. See, I'll tell you very clearly where it will work in index. Where it will work in index. Market should start, you should take positions here, and the market should close here. Then only it will work. Are we clear? Can I get one line of yes from everyone? Market should open here and it should completely close like this. Then only index will work. If it comes like this, both the premium will give you 50% loss. Obviously, our stop loss is only 25%. It will hit in no time, right? So my humble request is do paper trading before you enter into index or stocks or whatever it is. If you don't make profit in paper trading, you will not make profit in real trading. Can I get one line of yes from everyone, sir, madam? Especially in derivatives. Options is a very good avenue. There is no doubt. You can make unlimited profits. If you are expert in that, there is nothing better in life. I'm telling you, in life itself, there is nothing better, right? But it will take 3 months, it will take 6 months, it will take 1 year. Even after a long break, I have started now. I am in the mix of profit loss. So it will take time. I am okay with even with 1 year practice, but because rest of the life, I am going to take the benefit. Am I right or not? The first 2 hours market is sufficient to make a small consistent profit in Nifty options. First 2 hours market is far sufficient. Right. So next is short strangles. Any doubt in this? Long straddles. Any doubt? Okay. So short strangles in the sense sell call option and sell put option. That means we are selling both the sides. It should be done only in flat market. It should be done only in flat market or flat stock where no movement expected. So let's see. Option writing call, option writing put in the same stock or index. Option writing call or option writing put in same stock or index. Choose options in OTM only. It should be 5, 10, 15, 20 strikes later. I'm repeating, it can be 5, 10, 15, 20 strikes later. So how can I choose 20 strikes? Yes, if it is in the beginning of the contract, you can choose even 20 strikes later, right? It is very safe. Next, stock should not give big movement. That is our biggest concern or biggest requirement. Or because we are going to hold this position for 20 days or 25 days, 20 days or 25 working days. So it should not give big movement till the expiry happens. So the stock should not reach both the side strike price. For example, let me take one stock. Coal India, you can see 455 is the current market price. Now, let's say like for example, I want to create a position now. So what I can do is I can go with the previous high here as one level and maybe just below the previous low, I can take this. So now let's see the strike prices. Current market price is 455. I am taking 490 call and 395 put. 490 call and 395 put. Premiums will be very, very less now. 490 call I am going to sell and 395 put. It is very, very less. We can so let's calculate the current market prices 455 minus 490. 490 minus sorry 490 minus 455. I have taken let's about 35 rupees. So 455 minus 35, 420 call I have to take. So let's pick somewhere around 2 rupees. Okay. So now for selling this, we require 1.5 lakh rupees premium. I'm sorry, the span margin. For selling, we require 1.5 lakh rupees span margin. The maximum profit, how much you will get here is 7,500 rupees, 4.9%, which is a very decent amount for this activity. And you can see here, I have taken a very safe level, again for an example. But if you might have done this in the beginning of the month itself, we might have taken big benefits. Coal India, you can see here. So now 490 and somewhere 420 I have taken. So stock is completely in uptrend. So there is even 50 SMA support. Even if it is going up and coming down, it may take a support here. Again, it may take a support here. So you require technical analysis. Blindly, we cannot take a stock. If you take a stock blindly, it may keep on fall and it will give you unlimited loss. The disadvantage of the strategy is unlimited loss. But there are many other advantages. I'll show you. The stock should not give big movement both the side. Full span margin plus reserve is required. Reserve, we can keep it as 15-20,000. We can keep as a reserve because our stop loss is going to be very less, maximum 5,000 rupees. If it is breaching, we will close the position. The trade should happen in the beginning of the contract to take a complete benefit. This trade should happen in the beginning of the contract to take the complete benefit. Unlimited loss, so stop loss is very important. Again, stop loss is not based on the values. The right stop loss is not based on the values, it is based on the levels. So default stop loss should be 25% on the premium value, which is wrong. Who didn't understand this? This is just for a safer side. If you don't dare to hold the position, better don't do this strategy. Are we clear, sir, madam? The right stop losses, it should not reach both the sides. It should not reach both the sides. So option price is maximum profit. Actual stop loss is testing the strike price. Let's say like the current market price. CE sold, PE sold. So now the market price is here. It can go up, it can come down, it can go up, it can come down. Anywhere it can come down and again close above. We will get the complete profit. Same like that, it can go up, it can come down, go up, come down. Anywhere it can go above this level, the sold level, but it has to come down and close. So what happens? We take the complete profit. But in case if it's straight away, the next day you sold, if it starts going upside, you will start getting unlimited losses. So that is where you should be very clear in creating the positions. Let me put here. So now you can see we have 13 days for expiry. 13 days for expiry. Let's say like stock is giving 5% movement, 4 or even 5% movement. Are we in danger now? We have sold 490 call. It is a 9,000 rupees loss. Are we in danger? Answers. No, we are not in danger. Why? Because you can see here, it has not gone above the strike price. But when you see 9,000 rupees, it will be alarming. When you see 9,000 rupees, it will be alarming. But we should know little more analysis to understand next 10 days where it will go. You should see the market, you should see the stock news, or you should understand basic movement of the stock. If 15 days, if in 3 days, if it is giving completely bullish, it is better to exit at 5,000 rupees itself. Right. So now, if days goes, you can see loss will be subsequently, it will start coming down. By the time, even if it is going up and if days is moving, losses will come down. Now price will come down, we'll start getting in profit. Right. So when stock is giving, in this situation, when stock is giving complete bullish movement, you can book first this profit. It is only 15 paisa, right? You can book only this profit. Here we can close position partially. In this strategy, we can close position partially because it is almost like worthless. Or we can still hold. If the number of days is there, we can still hold. The number of days is there, so we can still hold, or else we can close the position. So next, when stock comes down, the sold position will give you profit. Again, remember, it is not a proper hedging. Hedging is limited to break even only. Hedging is limited to break even only. Stock should not close above 493. Stock should not close below 421. If there is a breakout on this level and closing above this, unlimited losses there. For expiry, you cannot do this. You cannot apply this in for expiry. Liquidity will not be there. Again, indirect loss will be there. Right. Monthly 1 to 2 trades is sufficient. Passive traders, money works for you. Say like for example, sir, I don't have time in market. I don't have big time in market. So I have 10 lakh rupees or 5 lakh rupees. You can pick a combination in the beginning of the month. You can pick a combination somewhere in between 5 to 7% combinations. So, and you can deploy up to, if you are having 10 lakh rupees, you can deploy up to 9 lakh rupees. You can deploy positions up to 9 lakh rupees. 1 lakh you can keep as buffer. 4.5 lakhs you can deploy. Again, 50,000 you can keep in buffer. So what is 54,000? You require only one trading day to execute these things. Is that fair amount? I'm telling very safer side. I'm telling you, if you are doing this activity in the beginning of the contract, if you are doing this activity in the beginning of the contract, you will be getting somewhere very far strike prices where we can't even think about that stock will reach there. Right? So multiply this into 10 times. Sir, it is exponential profits than bank fixed deposits because you are not actively in trading, right? You are taking one Sunday for execution, one Sunday for research, and one Monday for execution, right? Say like for example 450 and you have sold 490 call and 420 put 455. Now mark a price alerts 485 and 425. If there is no alerts throughout the month, is there any work for you? You are starting this activity by 28th April, for example, till 25th May, you are not getting any alerts. Do you have any work here in the market? Do you need to do? Is there any intervention required in this position? So, right, it will completely decay. It will completely decay. Whenever there is alerts, you have to see and very clearly no adjustments. I'm not going to teach you adjustments also. No adjustments, right? Adjustments will give you deep losses. Are we clear? Please remember this. Will this work in Nifty in far strikes? Yes, you can do. You can do Nifty far strikes. You can do, no doubts. Let's take an example. Nifty current market price is 22,750. Okay. Can we select the stock selection with less liquidity? Yes, but don't select Colpal, NTPC. Those things don't select. Reasonable liquidity should be there. Okay. Next is Nifty 22,750. Keep this election period away. This election period alone, keep it away. So let's take it like June series. Okay, June series. You can take 22,750, right? current market price is 22,750, and but you can see here June series future is 23,050. So you have to see from here only. So you can sell 22,600, 22,200 put we can sell, but 22,200 put, let's see future first. Let's see future first. Let's not do any guesswork. Future June 23,060. Okay, 23,060. Always remember option and future has a correlation. Option and cash has a less correlation. Remember that. 23,060. So now, as I told you, considering only the election point of time, we will not do this because 1,000 points will give a easy move if there is a whatever happens. So please remember that. Let's take 21,600 put sell, and okay, one more thing you have to do wherever there is a good liquidity. You can see here 22,000 there is a good liquidity, that is on 1,000 points from 23,000, and next is 21,500 there is a liquidity we can pick here if you want to be very sure. Same like that, 24, what is the price we have selected? 138. 24,500. Okay, 24,500, there is no strikes at all. Straight away it went to 25,000. 138 we have taken. So we can pick somewhere around 24,000. 1,000 points above. Yes, we can pick it. So now see this. Here premium will not be equal. One more update. When you buy long straddle, premium should be equal. Are we clear? But when you come this place, short strangle, premium need not to be equal. Our safety is important. Are we clear, sir, madam? Our safety is important. We should make sure that it will not reach in that place. So the total amount how much we are selling here is, we require 1,06,000. Maximum profit is 17,000 expected. So now days will play the role. So, but you have to wait for a longer period for getting this 17,000. But still it is 16%, right? It is 16%. 3 times of the expectations what we are doing in stock. So you can do this also. So if time permits, I'll teach you one more strategy tomorrow. So let's complete. You just remind me. Along with this, not so far, we'll be taking May contract as sell, and we'll be hedging with weekly contract. So it is in still testing phase only. So that's the reason I have not given that. So I'll check the result now. Just give me a minute. Trade virtual portfolios. Let's see what is the result. Okay. I didn't do covering. So you can see here, this was this and not this. Sorry, I'm sorry. Where is Nifty? Okay, Nifty hedge. So I didn't do the adjustments here. So here what we are supposed to do is, if we are in April, right, we have to take May call and put sell, and you have to adjust that with, you have to hedge that with, not adjustment, I'm sorry, we have to hedge that with weekly option of 20 rupees. So I'll give you clear data tomorrow. Let's not bring this today, right? So no adjustment, no adding positions. It will give you deep losses. So manage positions with price alerts. So examples, whatever I have shown you, same thing only. So these were the stocks Before 2 years I was doing. So it will be a predefined stock for a season. We can pick stock for one season. After that, you have to change it. Previously, it was Apollo Tyre, Ashok Leyland, Coal India, SBI. It will not move at all. SBI will give a movement, but still we used to pick the range. So 10% range we used to pick and we used to short. So time to trade and failure models, flat stocks which is entering consolidation, stocks which has a completed big movement, stocks have low volatility historically. So at least in the last 3 months, you should have a low volatility. Failure proportions, wrong proportions, wrong strike price, durations, wrong timings, all those things. So long versus short straddle, long straddle versus short straddle. Premium is enough to buy. Both option, call and put we will buy. Market should give big movement. Profit is based on movement. Limited risk, premium will become zero. So if you buy a premium of 30,000 rupees, the 30,000 rupees we will lose. Entry and exit should be done at a time. Maximum holding is 2 to 3 days. LTP should reach the target. That is, it should cross even 3 to 4 strikes above or below. Trade in ATM and ITM. Weekend is enemy. High beta stocks. Span margin is required. The capital is higher. Both options, call and put, we will short. Sideways movement is expected or required. Profit is premium. Unlimited risk. Entry and exit should be done at a time. Exits can be done partially, but entry should be done at a time. Maximum holding period is till the expiry. LTP should not reach the target. Trade in OTM, 5 strikes or later only. Weekend is favorable, low beta stocks. Any doubts? Can we get into the next topic? Okay. So we'll do one thing. We'll take a break. We'll resume by 7:48 p.m. Okay. We'll take a break. We'll resume by 7:48 p.m. and we'll continue. Again, another 30 minutes session will be there. We'll take a short break. Okay, let's start. So this strategy name is bull call spread, bear put spread. Bull call spread. So this is the strategy, two strategies we are going to learn today. And let's start. So option strategies, options are known for unlimited loss and profit when it is open or uncovered. Options are known for unlimited profit and loss when it is uncovered. Even future is uncovered. If it is a if this a future is uncovered, it is giving unlimited profit and loss. So hence what we did is we are covering that with either one lot or two lot opposite option. But options, when we trade options, we have to cover it. So how to trade in stock or index options with limited loss and limited profit. So here profit also will be restricted. So this process involves buying one lot ATM call. So let's be very clear because it will be very confusing if you implement this even after few weeks. Buy one lot ATM CE, buy one lot ATM call and sell third or fourth strike call in the same strike. Sell 3 to 4th strike one lot in same series. Same stock, same series, same stock or index, right? So in the same underlying contract with bullish in the stock or index. So now the trend here is the name itself is very clear. Bull call spread. So our trend is upside only. Upside only. Our trend is upside only. Direction uptrend is expected from the entry point for a profitable trade. So goal to profit from a bullish price action in the underlying stock with known risk. So we will know what is going to be the maximum profit, what will be the maximum loss, what will be the maximum holding period. Everything we know before we enter in the trade itself. Predefined we'll learn in the examples. Potential profit is limited. So maximum profit, potential profit is limited. Choosing the strike price. For example, buy ATM call one lot and sell third strike call one lot. Buying ATM is to make quick profits. Selling 3 to 4 strikes purpose. Why we have to sell this third or fourth strike? Pick the strike where the stock price acts as a target. See, when we make an entry, we know what is the stop loss, we know what is the target, right? So that strike we have to sell because that is acting as a resistance. So you can see here, for example, I am buying in this example Reliance. I am buying at 2318, one lot call, 2320 call, ATM call. I am buying at 46 and sell 2380 call. So I am expecting in 2 or 3 days it will give you 2% upside. Sell one lot call at 20 rupees. So when you buy, the premium will be 46. When you sell, the premium will be 20 rupees. So it should be half the amount of the buying premium. So Reliance current market price 2320. So let's understand the scenario. Then we will create a worked example. Reliance current market price 2320. I'm expecting the stock to give 2 to 3% upside in 3 days time duration. So time is very limited. We cannot hold till the end of the month. Set off your target stock to reach around 2360 to 2380 in 2 to 3 days. Now buy one lot 2320 call at 44. Sell one lot third strike 2380 at 20. So you can see here buying one lot at 44, selling one lot at 20. So the difference between the premium is 24 rupees. So this will be the maximum loss, right? Next. So investment required. So we are buying one lot premium. So how much? It is 11,275. But when you sell one lot call option, we require the complete span margin. So buying has to be done first second. If you sell the call option first, you require entire 1 lakh rupees. So you have to buy a option first. Immediately within minute, you have to buy this also. Any doubts, sir, madam? The final margin required is to place the order, you require 31,000, and once the order is executed, you require 26,715 to hold the position. That's all. So now 50,000 required including proper money management. 50,000 required including proper money management. Maximum profit. Let's say like Reliance moving 2 to 3% upside around your target within 2 to 3 days. So you can see here 1.9% it is moving from 2320 it is moving to 2360. So the call option which we bought will give you profit 5976. The call option which we sold will give you loss 3500. The profit will be 2500. So Reliance moving upside 2 to 3% around your target at the end of expiry. At the end of expiry. So if the movement happens in 2 to 3 days, so we are defining this into two parameters. In 2 to 3 days, if the movement is happening, you get less profit. If it is at the end of expiry, again there should be a movement of 3%. What will happen now? The sold option will become zero. The sold option will become zero. The bought option, it will give you profit, exponential profit. So you make money both the places. Are we clear, sir, madam? So it is a tricky thing. You should hold the positions only if it is in profit. Say like for example, I bought at 2920. Okay, spot or future, whatever it is. It moved to 2320. I'm sorry, so I'm speaking about the current price. 2320 I bought. It came to 2380. Okay, so now this premium became ITM. This premium 2380 I sold. This became ATM. This became worthless. This became worthless because expiry happened. Expiry happened. But now what happens? It goes against us. So we have seen first and second instances. If it is towards your favorable direction and if it is not crossing completely the sold strike price, yes, we can hold. Next is maximum loss. Maximum loss. When the stock goes downtrend against the expectation. When the stock goes downtrend against the expectations, as the position one call and one call buy and one call sell, the bought call option will become zero and the loss is fixed. That means whatever happens, you will not lose more than 6,000 rupees in this particular trade. Any doubt? Whatever happens, you will not lose more than 6,000 rupees in this particular trade because the loss is in between the difference of the premium bought and premium sold. So that will be the maximum loss. You can see here. So now let's go with the example. Give me a minute. Predefined it is here, but we will not go with the predefined. We will do it manually as per whatever we learned. 2959. Let's buy 2960 call. Okay, we'll buy 2960 call and let's keep a target. Let's see the chart first. Always see the chart. So let's say like if it is giving a breakout, 2955. If it is giving a breakout, it will go till 3050, 3057 it will go. Let's keep 3040 as a strike price. 3040. I am selling this as a target. Any doubt till here? Maybe even if you didn't understand over the PPT, I'm showing it here again. Sir, madam, any doubts? I am buying a ATM call. The same strike, I am expecting a uptrend. So I am buying a ATM call number 1. To hedge my position for a protection, what I am doing is I am doing selling in the same strike price at my target, that is 4 or 6 strikes later, 4 strikes later. Okay, now let's see. The capital required is 33,000. Maximum profit is 12,000. Maximum loss is 7,225. Any doubts still here, sir, madam? Can I get one line of yes from everyone? That means when you enter the trade itself, you are very clear about the maximum loss and maximum profit. Sir, on a capital of 33,000, if you get 12,000, it's good, right? Right or not? It's very good. So now let's say like in 3 days, stock is giving 3 to 5% movement. Always remember the 3% movement is very, very important with momentum. Any doubt in this, sir, madam? 3 days is fine, but in 3 days, at least in 1 day, stock should go upsurge like this. If stock is going like this, you will not make profit in option. Any doubts, sir, madam? Profit loss. Who didn't understand this? Let me put again. Whenever you trade an option, whether it may be a combination, whatever it is, stock, it can go like this, but it should go like a momentum. It should go like this. Then only you will make profit. The same 3%, if it is going like this, you will make big loss only. There is no doubt in this. Are we clear? Especially index trading. Especially index trading. That too weekly expiry. Right? We require stock to go above with momentum. For example, I can show you today's. See, this is called as momentum. This is called as bullish Marabuzu candle, open and close completely. If you see candle like this, after you take the position in a daily chart, definitely the premium will not rise, it will be in loss only. This is both the side movement. All these places we will make loss only, no doubt in this. Profit, loss, loss, profit. If you are in put option, loss, loss, loss. Are we clear? That is the reason option is a risky instrument. It should give up, it should go with the momentum. So now let's say like stock is crossing 5% and days is going, still you will make profit, but only subject to 12,775. So now you can see here, stock is moving 15 days to expiry, 15 days to expiry. Let's keep like in 5 days, stock is giving 10% movement. Still, you will make only 12,000 rupees profit only because profit is locked in the upside. The option which you bought giving you profit, this will give you loss. It is locked to a maximum potential upside. So loss also will increase, profit also will increase. So when you see 12,000 profit, you can exit the position, no point of holding till the expiry. Are we clear, sir, madam? Next. Now, what happens if it is going against me? So when you buy this, you will not keep 5% stop loss, right? Am I right or not, sir? When you buy your Reliance option, how many points you will keep stop loss in spot? Can someone tell, sir, madam? Answers, please. So 3% is too much, no? 3% is too much. It is only for cash market. When you trade in options, you can keep a stop loss 1 to 1.5%. That means on a stock value of 25% option, 25% in the option value is just for a disaster management. So I request, sir, madam, please to go and see the basics again. Okay. Cash market 3%. Disaster management is 5%. TSL 2 to 3% only. Okay. Maximum stop loss it can be 5%. Future 1 to 1.5, and there is no maximum. We can keep 0.5 to 1 as a normal entry. Maximum it can be 1.5 if you are expecting a good, very good risk and reward. And for cash and for options also same. Any doubt? You cannot keep 3% stop loss, 25% as a default stop loss. Default 25% is a disaster management. You bought a premium at 500 call. Stock is not at all moving. 502, 505, 499, 497 for 3 days. 25% option will become lost. Then you exit. This is disaster management, right? But when you make an entry at 500, your stop loss is 490, 490, and by the time option will give you only 15% loss. Exit